during today's session, I got to tell you, it was another solid outing. The major equity indices have now staged a 4-day rally in the midst of this so-called trade war. And I will say that today's session, though, underscored this persistently frustrating issue for investors. And the bottom line is you just can't throw a dart, right? Because there were barely more winners on the New York Stock Exchange than decliners, and there were substantially more losers on NASDAQ than winners. The market opened in the plus column, and then it kind of gingerly worked its way, even as the internals began to shift, not for the better. The Russell 2000 turned lower after it hit a new all-time intraday high, and lots of high-flying tech names started to stumble into the close. Now, I mentioned consumer staples last night. Well, today it was the best performing sector, led by PepsiCo, which posted better than expected. Organic growth in North America, a big deal for them. The cautionary tone of the market, though, was reinforced after the Bureau of Labor Statistics reported the JOLTS report, you know, with the job openings and labor turnover. And here's the thing. Overall job openings, they slipped a little bit, 6.6 million from 6.7 million. The headline, a record number of Americans calling it quits. Up 212,000 in May. The quits are now 3.6 million. It's an all-time record going back to 2000. And it's also leading more anecdotal evidence of a big wages that they might be right around the corner. Remember, these quits, they feature prominently on Janet Yellen's economic dashboard. I'm not sure how important they are for this current Fed, but there's no doubt a potential spike in wages scares the heck out of Wall Street. And nothing is a better harbinger of higher wages than a tsunami of folks telling their boss, take this job and shove it. There were some other red flags after a nice bounce yesterday. The financials looked awful today, weighed down by regional banks, but also those big money center institutions were lackluster as well. The XLF is now down 2.6% for the year, but get this, almost 10% from its January 26 high. And remember, that was the day President Trump went to Davos and he threw down the gauntlet on the global elite establishment. Right now, the XLF, if you look at this in the chart, it's in what they call a descending triangle. It's made a series of lower highs. That means at some point, I think very soon, it's going to make a decisive break. I don't know which direction, but if it doesn't go up, it's in danger of a big collapse under support. That probably will get more news on this Friday because that's when you get big four financial names reporting their quarterly earnings. All of these names, by the way, are down this year. Citibank is down more than 8%. JP Morgan is fractionally lower. Wells Fargo is off almost 7%, and PNC Bank almost down 5% for the year. Financials are expected to see revenues up 4.5%, earnings up 22%. So there's big hopes for them, big hopes overall for earnings. Remember, we had a monster first quarter. Wall Street looking for lightning to strike again. A bonanza, we'll see. You can see what we got in the first quarter. You can see what Wall Street's looking for in the second quarter. It all begins on Friday. I will just say 3 days ago, I'm excited, but I got to tell you, there have been so few earnings warnings. I think that's also a great sign going into Friday. But at the end of the day, it's really about forward guidance.